All right, we're going to go ahead and get started. Happy New Year, everyone, and welcome to PrimePay's first broker webinar to ring in the new year. Happy 2017. Today's webinar is titled The 21st Century Cure for Small Employers. Hello and welcome. My name is Steve Jackson, and I am the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and we want to welcome you to the first of our 2017 webcast. Before we get started today, though, allow me to cover some of the logistics of the webcast, okay? So due to the volume of the attendees today, we have muted everyone's lines, all right? But that does not mean that we do not want to hear from you. As I go through the content today, I'm sure that you have questions, and you're going to want them to be addressed, and we'd love to hear from you. So what I'd love for you to do is to go directly into the Go to Meeting menu bar, and into the question box, and go ahead and type in your question. You can do that at any time throughout the webinar here today. Okay, and so as I go through some specific content pieces, please feel free to go ahead and type in your question. I will do my best to address the questions throughout the webinar, or certainly at the end. However, if I'm unable to address your specific question, because several of you have more direct or specific questions as to your agency, clients' needs, and so forth, no worries. Upon completion of the webinar, we will absolutely reach out to you directly and provide the answers to your questions. One of the standard questions that we receive regularly is about whether we are recording our webinar. So to answer that question, so no one needs to type it, we are. All right, we are recording it. We will be sending you a follow-up email after the webinar here today, or actually probably on Friday, around Friday, and it's going to contain a link to the recording. Now, you can always visit our public Broker Concierge channel on YouTube to view many of the past webinars that we have presented. So feel free to go there on a regular basis and view those webinars. That should do it, though, for now, at least in regard to the logistics. At the end of the webinar here today, I will share some additional details as to our follow-up and our follow-up email to our exclusive Broker Concierge partners. So stay tuned for that. So I have had the distinct pleasure of bringing these webinars to you monthly since 2008. It has been a wonderful experience for us, and your loyalty is absolutely felt, and we truly appreciate your commitment to attend these webinars and also for entrusting your clients with us, with PrimePay. Over the years, we've had a consistent desire to bring relevant, comprehensive, but very importantly, practical content with the hope that by attending, you'll be able to communicate that regulatory piece of guidance or that complicated technical requirement, and above all, that practical application easily and more effectively with your clients. We had performed our yearly broker survey with you last year, and the majority of you communicated that one of the best ways that we here at PrimePay can better serve you and your clients is to keep you both well educated and informed about the major compliance items of our day. So with that spirit in mind, today we open our 2017 broker webinar series with a key piece of legislation with today, or those whom you are prospecting. As I'm presenting this to you, Congress and President-elect Trump has already begun the preparations of dismantling, altering, or composing their own form of ACA, right? We'll see what that ultimately looks like. But whether the result is a full repeal or is majorly altered in some form or fashion, the 21st Century Cures Act has already began to transform the requirements and mandates of ACA for small employers. So let's go ahead and learn more about this cure for small employers to determine whether it successfully eradicates the financial burden of the cost of providing health care, or if it is simply another Band-Aid in treating this important employer-sponsored benefit offering. So let's go ahead and dig here now into the agenda today. All right. So for many of you who have joined us year over year, month after month, we try to bring some specific pieces of content to you. So that generally means that it is a smaller agenda, right? That we shouldn't have a lot to talk about. Our internal people keep telling me, Steve, you're doing too much. Bring it down to just a few. So that's what we're going to keep trying to do here in 2017. But today's agenda, as we open up 2017, is really focused on this 21st Century Cures Act. And so today in our agenda, we're going to focus very narrowly on as a comprehensive review of the Qualified Small Employer Health Reimbursement Arrangement, okay, or otherwise known, as I'll say here throughout the webinar today, QSEHRA, as it's often called here now. We also want to address some specific sales strategies that you as a benefits broker should consider as you begin to communicate this specific opportunity or benefit offering here to your employers. We want to talk about some next steps, and then at the end here, as I wrap up, I do want to kind of showcase to you kind of our 2017 Broker Concierge Partner Program. We are thrilled to call many of you our Broker Concierge partners, but many of you here today on the call are not as familiar, and I just want to lay the ground for how Broker Concierge can actually assist and support your agency throughout 2017. All right, so as we dig into our content here today, you know, I think we all remember here back in, well, I do, maybe you don't, but back in September of 2013, there was IRS, Department of Labor, and HHS guidance that came out in relation to HRAs. And it provided how HRAs could be used going forward as it pertains to the ACA obligations and requirements. As many of you are well aware, an HRA, generally speaking, is a group health plan. And so therefore, when the 2013-54 notices came out about HRA guidance, it started to specifically address how HRAs were not going to be able to be used to reimburse individual medical premiums. And it specifically was addressing market reforms such as Section 2711, which said that a group health plan could not establish any annual limits, right? You guys remember that? And Section 2713 had stated that a group health plan needs to provide for certain preventative services without imposing any cost-sharing requirements for these services. And HRAs, being group health plans, kind of got caught or stuck into those specific market reforms. And so therefore, as we know what came from that guidance, it stated that, okay, there's a few ways that you can utilize an HRA. If an HRA is going to be integrated with a group health plan, you can reimburse your qualified medical expenses, deductible expenses, so on and so forth, right? But you couldn't just have a standalone HRA unless that standalone HRA was a retiree HRA or possibly an accepted benefit HRA that would cover dental, individual dental premiums, vision premiums, hospital indemnity types of premiums, and so forth. So what we found back in 2013 was this limitation. Well, the limitation has not been completely removed for all employers, but the 21st Century Cures Act was signed into law by President Obama December 13th, 2016. And it has paved the way for small employers to utilize an HRA in a more dramatic fashion or in an allowable fashion here now, specific to unreimbursed qualified medical expenses, out-of-pocket medical expenses, and individual medical premiums. All right, so let's just do a quick review before we take a deeper dive into each one of these sections. So what the 21st Century Cures Act created, okay, is now what's called the Qualified Small Employer HRA, okay? And again, I'll be referring to it as that throughout the webcast here today, but also by saying QSEHRA, okay? So it's all something, a new acronym here we got to get used to. The Act acted very quickly, actually. So as of December 13th, the president signed it into law, and it began to be effective for plan years beginning January 1st, 2017. So in essence, it enabled those qualified employers to be able to implement a qualified small employer HRA as of January 1st. It also discussed the specific employer qualifications, and we're going to go into greater detail. Not all employers are eligible for this particular benefit plan offering. So there were some specific qualifications, and we're going to go over what that small employer really truly means. Qualified eligible expenses, as many of you know, HRAs over the many years, HRAs are established to be able to reimburse qualified medical expenses, and this is no different. As this is an HRA, we're going to talk about where what the qualified small employer HRA can absolutely reimburse in regard to those expenses. And then lastly here on this bullet, it did also speak, the provisions also spoke about certain penalties that can or will apply. Okay, and so we want to cover all of these in some greater detail here for you today. So the first item that we want to cover here today is the eligible employer. All right, so there's a few things. Unfortunately, actually, what I'm excited most about is that within this act, that they actually retained a definition that we're accustomed to here already. They did not create a new definition of what a small employer would be. Okay, so what they have defined as an eligible employer, at least one of the pillars. Okay, you first need to be considered a small employer, which would mean that you are defined as a non-applicable large employer that is defined there under ACA. So we've spent the last couple years, right, talking about, actually a few years, in regard to who is a large employer, that applicable large employer, and who's going to be responsible under the employer mandate and the ACA reporting requirements, so on and so forth. But the QSEHRA is actually, that employer who is eligible is defined as a non-ALE. So that's generally going to be an employer, generally speaking, fewer than 50 full-time employees and equivalents. Okay? So as you're speaking with employers today, it's not the number of employees that they have here as of January 1st, 2017. You do have to look at the previous year, and that will determine whether so they'd have to look at 2016 and perform their employee calculations in 2016 to determine if they are eligible for QSEHRA here in 2017. So it's not just a, hey, if they're just at 35 employees, don't just assume that they're eligible. You need to have them perform that calculation for all of 2016. Okay? One thing that I want to bring up here, and it's that second bullet point underneath this first section, and that's the controlled group rules apply here as well. So what you do need to be aware is that in the rules to determine whether you're an applicable large employer, you have to also bring into the discussion whether that employer is also associated with or has common ownership interest in other entities, and those are called the commonly controlled group rules. So in determining whether they are an eligible employer for the QSEHRA, the employer will also need to look at any other commonly owned group rule interest. So if you have, for instance, or as an example, you have an employer here with 30 employees, okay, and they also have common ownership in two other companies that have 25 employees apiece. Well, if we were to count those three entities up, they're well above 50 employees, right? So under the applicable large employer controlled group rules, your client, let's say with 30 employees, would be considered an applicable large employer and would not be qualified for the qualified small employer HRA. So please consider how you would qualify a small employer. The first step is ensuring that they are a small employer, which would be defined as a non-ALE, okay, a non-applicable large employer. The other key requirement, so that's kind of the first thing, right? We want to make sure that they qualify as an employer based on size. Okay, they are definitely a non-applicable large employer. There's a couple other key requirements that will then enable this employer to move forward and qualify for the qualified small employer HRA, and that's these three things. Number one, this employer, so once they've been determined as a small employer, they are not offering a group health plan to the employees. Okay, they are not making forth that offer of a group health plan. Very important. Also, number two, when they make this contribution to the HRA, that it's funded solely by the employer. The employer cannot take any salary reductions from the employee or take deductions or take income or wages from the employee in order to fund this qualified small employer HRA. So it needs to be funded solely by the employer. And lastly, there are some specific notice and reporting requirements that do exist. You all are probably very familiar, right, with an HRA. An HRA is a Section 105 plan. It is an ERISA plan. It's a group health plan. And under those rules, we need a plan document. We need summary plan descriptions. We need an adoption agreement that needs to be implemented or executed. And then there's an annual non-discrimination test that's required with those things. So along with this, and I'm going to go into the notice and reporting requirement a little deeper here in another slide, okay? But do note that there is a specific notice and reporting requirement, and it is different than a general HRA, okay? But there is that requirement to provide that notice. Okay, I'm just going to see one of the questions. Daniel, or actually John, you had provided a good question about the funding. When we talk, I wasn't going to go into the grander details about funding the HRA here today, but the question was asked by John: does it have to be unfunded HRA, or must it be funded? You know, generally speaking, an HRA needs to be funded through the general assets of the employer. You shouldn't segregate the assets. It should truly come right out of your general assets of the employer. It can be funded, non-funded. It can be put into a trust account, depending on the situation and liability of that employer. So there are no direct rules. In fact, we would say don't fund it. Don't fund a separate account specific to the HRA, because then you can create or have the potential to create an ERISA type of an account. So funding can be partially, or just funded out of the general assets of the employer. All right, plan eligibility. As you are probably aware, with many of the HRAs that you have implemented with clients here over the last several years, you generally have an HRA that's integrated or attached with a group health plan, right, of that employer. And the HRA is specific to eligibility and enrollment in that group health plan. And what I mean by that is, you get the HRA employee if you enroll in the group medical plan that I am offering, okay, that where the HRA is integrated with that particular plan. So there's always been an eligibility, a list of eligibility requirements for an employee to be eligible for the HRA. The qualified small employer HRA is no different, okay? So in this first bulleted section, the employer has the ability to determine eligibility. Now, under the provisions of the Act, it states that all employees, okay, can or should be eligible for the benefit. However, as an employer, do you really want to give it to employees who are part-time and or seasonal? Well, they could check that off to say, listen, this benefit, it's offered to all full-time variable hour employees, but no part-time or seasonal employees. You can also exclude employees additionally for employees that are just going through their waiting periods, less than 90 days of service. You can exclude employees 24 years of age or younger. I mentioned part-time and seasonal. You could also exclude based on collective bargaining agreements. You could exclude employees under a union or a collective bargaining agreement, and also non-resident aliens who receive, no U.S. income. Okay, so this is really, it's not much different than a regular HRA. HRAs under Section 105 have provided similar provisions of eligibility that employer could say, hey, I want to include or exclude certain types of employees. And these are the 5 kind of items here of employees in which you could exclude them. All right. Also, as you also know about HRAs, you have the ability within HRAs to vary the reimbursements based on class. Many times employers vary the reimbursement account based on just, whether you have single coverage or family coverage, okay? But and that's kind of the general, that's the common thing, but an HRA also enables an employer to vary based on similarly situated employees, exempt versus non-exempt, union versus non-union, management, you can class certain employees. Now, the main thing with an HRA under Section 105 is that you cannot be discriminatory, right? So if you run your annual non-discrimination test, you need to make sure that you are not actually benefiting the highly compensated employees more than the non-highly compensated employees. But do know through the QSEHRA that reimbursement amounts may vary, okay, and they can vary by these 3 things. They can vary by age of employee. All right, so I don't know if an employer, a small employer, is willing to maybe age band their reimbursement out of QSEHRA, but they potentially could. I'd mentioned that a very common way of varying the reimbursements would be based on insurance coverage status, so maybe they're single versus family. You're going to have different amounts for single coverage versus family coverage. So you do want to just note here in this 3rd item is that the annual HRA allotment must pass the non-discrimination test. So we do want to ensure that although you may be classing as to or as per similarly situated employees, you want to make sure you're doing so not in favor of those highly compensated employees. Another key piece of plan eligibility, see under HRAs, reimbursements are tax-free, right? An employee incurs a claim that is a qualified expense under the HRA. They submit their substantiation material, an explanation of benefit statement, whatever it may be, and they get reimbursed. The employer reimburses them, and that is completely tax-free to the employee and tax-deductible to the employer. There was one stipulation, though, in regarding the plan eligibility and the tax-free status of the reimbursement from QSEHRA. And the one specific aspect is that the employee must be covered under a minimum essential coverage plan, okay? They must be covered under that bronze level, silver level, whatever that may be, but must have minimum essential coverage, and if they are covered under MEC, then that reimbursement from QSEHRA is tax-free. If the employee is not covered under an MEC plan, then that reimbursement to that individual would be taxable. All right, so that's just one little caveat that you do want to make sure that you follow here with that. The last item is the coordination of COBRA, all right, and I've already seen a couple questions here as it relates to this QSEHRA in COBRA. So it has specifically been stated in the Act that the QSEHRA is not considered a group health plan. So this small employer HRA is not a group health plan, which means it is not going to be enforced under the provisions of ERISA, okay, or the Protected Health Services Act, PHSA. So that means that a QSEHRA is not eligible for COBRA, okay, which is a very good thing. Many of the attorneys and opinions out there today on this actually very much welcomed this information because it alleviated a lot of issues, actually, if COBRA was going to be in play with this. So, under the coordination of COBRA, a qualified small employer HRA is not considered a group health plan, and therefore it is not eligible for COBRA continuation. All right, let's get into plan design here. Under an HRA, as you guys think about a general HRA, under Section 105, an HRA allows for the tax-free reimbursement of qualified medical expenses. You know, HRAs have never allowed for transit and parking, you know, just other mileage reimbursement, and what you think of it, you name it, you know, it doesn't reimburse. It only reimburses qualified medical expenses. Now, the beauty of any HRA is that the employer can actually choose which expenses, which of those qualified medical expenses they can actually or are willing to reimburse and be permitted. So under the qualified medical expenses, okay, that are eligible under a qualified small employer HRA, is any of the medical expenses listed under or within the 213D Internal Revenue Code section. And that covers, if you just think about the general health FSA types of rules, okay, as far as what can be reimbursed, we're talking about any out-of-pocket medical expense, dental, vision, any medical expense that is out there trying to treat and alleviate a specific condition or disease would be considered a qualified medical expense. Okay, so all those out-of-pocket medical expenses would be eligible, but also the beauty certainly within the creation of this qualified small employer HRA is that it now allows for the reimbursement of individual health insurance premiums. And again, just putting in there that it needs to be minimum essential coverage, okay, through that. So qualified medical expenses, it is all of the out-of-pocket medical plus the individual health insurance premiums, which can also reimburse your supplemental, your Medicare supplemental premiums. I believe that that is one of the questions that were asked here. So it can cover the Part B and D, you know, there as well. Okay. Prior year claims eligibility. Many of you might have established an HRA with a client and they wish to roll over or carry over the funds, any unused funds from the previous plan year. That is certainly allowable within a general HRA or certainly a retiree HRA or an accepted benefit HRA. Under a qualified small employer HRA, that is not the case. A rollover is not permitted. However, they have made an exception, which is not a bad exception, okay? And what they've allowed for is prior year claims eligibility. And what that means is that claims that were incurred in the previous plan year, so let's say in 2016, let's say I had claims incurred in 2016, but I did not get them reimbursed because I didn't have enough money in my HRA account to be able to reimburse myself in 2016. I can get reimbursed for that claim incurred in the subsequent year, or here now in 2017. So I, as an employee, I incurred a claim here last year. But I didn't have any money left to get reimbursed. I waited for my credit amount here in January of 2017. I now can submit a claim and get reimbursed from that money that I incurred, that expense that I incurred in 2016. That's a very nice exception that is allowable. So very nice feature there of a QSEHRA. Flexibility of reimbursement structure. You know, I've always said that HRAs are a lot like snowflakes. They're always different, right? Each employer is creating, developing, implementing an HRA to fit their specific needs, and they look so differently from one employer to another. A QSEHRA allows for that same or similar flexibility. So the employer has complete flexibility in plan design or how they want to actually drive that reimbursement and to what expense they're willing to reimburse, right? So any qualified medical expense and individual health insurance premium is eligible as a qualified expense, but each employer can determine, well, you know, I only want to reimburse X or I only want to reimburse Y, okay? Or I want to reimburse A through Z. I'll reimburse everybody. So the reimbursement levels could be at 100%, you know, where the employer says, hey, I'll just pick up 100% of your, you know, your first incurred expenses up to a certain amount. I'll pay 50% of your known expenses. I'll pay first, you pay second. There's a lot of different ways that you can establish then the reimbursement structure, and we'll go through an example here in a second. The QSEHRA, too, is also prorated. The benefit amount is prorated for new hires, okay? So, for instance, if, the maximums there are listed. So the annual contribution maximums that can be reimbursed through a QSEHRA is $49.50 for individuals, and then all others or family coverage would be $10,000 would be the maximum, okay? So an employer can go all the way to the maximum, or they could certainly go anywhere in between in regard to the amount for the entire year. But it is prorated monthly. So if you started the year with providing an employee $100 a month as of January 2017, so that's an amount of $1,200 for the year, but you had a new hire that started in July, okay, they would only be eligible for $100 a month going forward, or $600 for someone being hired in July, as an example. So it is prorated for new hires. Let's look at just a couple examples. I just wanted to try to bring it to life a little bit as far as, not going to the extremes, but just providing a couple examples on how to make this work. So let's say this employer wants to reimburse individual medical premiums. That's it. Okay, they just want to reimburse premiums. They can establish that. The employer can actually establish that QSEHRA stating that only. And then they can also then name the amount. Well, they can't go above the maximums, the annual maximums, but in this case, the employer says, I'm going to give those with individual coverage $300, and those with family coverage will be $600 a month. So as you can see, they're clearly under the $49.50 and the $10,000 for the year, and so that would be an allowable or permissible type of a plan design. The second one that I'm just showing here is now the employer is just being more open. They want to reimburse up to the annual maximums, the $49.50 and $10,000, and they're saying, hey, I want to reimburse any individual medical premiums and any qualified medical expenses, but I'm doing it on these benefit terms. I'll reimburse 100% for the premiums, excuse me, but I'll reimburse 50% for any qualified medical expenses. So it is, so I just want to showcase that the employer in offering a QSEHRA has the ability to kind of transform and implement that QSEHRA as they need to based on their conditions and what they ultimately need. So remember that this is an HRA which enables the employer flexibility in plan design. All right, claims processing. So many of you have gone through the process with your employers and employees in submitting claims, the substantiation process for a general HRA plan design that had been implemented. Under the QSEHRA rules and requirements, claim processing, the substantiation process is still required. Okay, and so I just list here, there's two main bullets, the 213D, the non-premium expenses, so that's the qualified on a regular basis. Last here is the individual premium. So the employee needs to show that they have proof of coverage, right? So I had mentioned that it's important that the employee has MEC coverage, and that MEC allows for that tax-free reimbursement. Now, the legislation has not necessarily described what proof of coverage is. So it's a little bit up to interpretation and up to the comfort of the plan administrator or employer with what is provided to them to prove that. Now, certainly a benefit summary from the carrier, a proof of coverage showing a paid bill, that would reflect that the employee certainly was covered under MEC and that they've actually are covered under that specific plan. So a paid bill would be very helpful, but in the early going, as that employee enrolls, they're going to need to provide information about their specific plan. Generally speaking then, this would be a manual claim submission, okay, for claims processing, and not where a debit card would be utilized, okay, on a regular basis. Reporting. I mentioned in the quick summary that there was a reporting requirement that was tied directly to the qualified small employer HRA. Now the first one here is, or this first bullet, honestly is not, it's not new. I mean, there's under an HRA, under Section 105, there's always been a summary plan description requirement. In this notice, it must contain what the reimbursement amount to the employee is. Kind of sounds like a no-duh statement, right? It'd be nice for the employee to know what's the amount that is available to them, all right? So reimbursement amount. They also need to be informed that they're going to need to provide this benefit information to any health exchange regarding a premium subsidy. So maybe some, many, all of these employees will be trying to qualify for a subsidy. So they're going to need to provide this amount within the subsidy calculator to determine how much or if they would qualify for a subsidy. So they're going to want to use this information when they apply. And then also it needs to describe the tax consequences, or at least state the tax consequences of QSEHRA reimbursements and failure to maintain an MEC plan all throughout the year. Now, the employer does have a penalty for a failure to provide this notice, and that is $50 per employee up to a max of $2,500. Okay, so not too bad, not crazy penalties, but the IRS, or the IRS had said, listen, we're going to provide some relief. So there is some transition relief as it relates to the notice. Because here at PrimePay, we have already established as of January 1st some of these plans, and yet we don't have all the plan documentation here established yet. And so what the IRS has provided is a little relief for the first quarter of 2017, and employers are not obligated or required to provide that notice until April 1st, 2017. And that should give us here at PrimePay, you, your clients, the opportunity to be able to prepare that specific notice. Also, the last item in the reporting requirement, and this is new because we don't do this today for an HRA, the employer must, or a general HRA I should say, the employer must report on the W-2 amounts contributed to the qualified small employer HRA. So if that employer is providing $100 per month or $1,200 for the year, that amount is now going to be included on the W-2. And presumably, we are assuming here right now it will be reported for informational purposes only, and it looks to be put in box 14. You guys are providing some great questions, and I'm going to keep trying to tackle them here as I go along. So good stuff, everybody. Keep that up. The next item, and this is a question that has come up several times here from you all here today, is this coordination with the health insurance premium credit. And so that tells me that you guys have been doing some research. So that's good. We need to talk about affordability. All right. What does this small employer HRA amount, this benefit amount, what does it mean for an employee who is going onto the exchange and trying to qualify for a subsidy? Okay, so in that first bullet, it states the QSEHRA will affect an employee's eligibility of the subsidy, that advanced premium tax credit. And it is considered affordable with these two items, all right? And I'm gonna show you an example here in a second, so bear with me as I read this information. The QSEHRA benefit is considered affordable if 1/12 of the employer's contribution, so it's taking that amount, that $1,200 amount for the year, take that over 12 months, so that's $100 a month, is not less than the monthly premium for a self-only second lowest cost silver plan, okay, which is what it's based off of, okay, the affordability. And the employee's cost of coverage for the individual market coverage does not exceed 1/12 of that 9.5%, or now through cost of living adjustments, 9.69% of the employee's household income. Now, before I show you the example, I want to just show up another reminder here, okay, that, this is a small employer, all right? These are qualified small employers. As I said, they're defined as non-ALEs. So employers eligible to sponsor a QSEHRA, they're not subject to the employer mandate, okay? They're not subject to the penalties. They don't have that any in place, all right? So as an employer, you just need to be cognizant that the amount that they're providing to their employees can affect that ability to get or achieve a subsidy on the premium. So I just wanted to break this down with an example, if I may. So as this example shows, let's assume that the second lowest cost silver plan, so this is for self-only coverage, okay, is $300. The QSEHRA, as I had mentioned before, the 1/12 benefit amount is $100. The employee earns a household income of $2,100 per month. So if we take that $2,100 and multiply that times 9.69%, we get to a little bit amount over $200, $203. So in this example, okay, the $203 exceeds the $200 difference between the applicable marketplace plan and the QSEHRA monthly HRA benefit amount, which means, or this results in, the ability for this employee to receive a subsidy, because this would actually be deemed affordable, okay, in this example. I didn't create another example, but if all we did was just change the second lowest cost silver plan here in this example to $400 instead of $300, which means that the difference between the marketplace plan and the QSEHRA would be $300. Now, that difference in my example would actually make that not affordable, and at least likely that they could qualify for a subsidy. So just remember that the 9.69% is based on the employee's household income, and your small employer is not necessarily going to have knowledge of what their household income is when they determine the allotment for that benefit. Okay, so hopefully that was helpful there in regard to affordability. It gets a little confusing when you just read the regs on there, but I hope that this example kind of brings it to life here a little bit. One of the questions that have popped up is, can a 2% or greater shareholder in an S corporation, or a any 1099, a self-employed sole proprietor, partner in a partnership, can they actually participate within this particular benefit? And the answer is no. So the same ownership rules apply with a qualified small employer HRA as it does to a general HRA benefit today. So that specific, there's been no relief given to those specific ownership rules that are in place. So let's do a quick review. That's a lot, right? It's a lot of information there kind of thrown at you, I'm sure. So in a quick summary here, I suppose, at least on a one slide, let's just quickly look at the eligibility, the eligible HRA plan designs here, and I've listed 4 at the top. You have today under Section 105, within HRAs, you have what I'm calling here a general HRA, which is that standard HRA that is integrated with a group health plan, right? So when we look at an employer type, a general HRA can go with any size employer, okay? The eligibility just comes in where that HRA needs to be tied to, connected with, or integrated with a group health plan. Next that I show here is the qualified small employer HRA. And again, the employer type where those would qualify would only be for non-applicable large employers, okay, only. So non-ALEs would comply. And do you remember how to do that calculation? You have to look at the previous year. So don't just assume this year, and also don't forget commonly controlled groups, because that can impact whether they are an ALE or a non-ALE, that status. But the main eligibility for a QSEHRA is that no group health plan is offered, okay? Next is a retiree. As part of the ACA market reforms, there were some accepted benefits, some exceptions that kind of were brought forth, and certainly the remaining 2 HRA designs here, retiree and accepted benefits, came from that. And so any employer can have or offer a retiree HRA, so it affects or applies to all employer types, but the eligibility factor is it's available only to retirees, right? So it's only to those that are deemed or defined as retirees. And then under accepted benefits, this does apply to all employer types. So all employers can actually benefit from an accepted benefit HRA, which is generally the eligibility for that would be where you're establishing an HRA for dental expenses or premiums only, vision expenses or premiums only, hospital indemnity, so on and so forth. So those are very specific. So as you look at these 4 items, think about your arsenal of HRAs that you have at your disposal. The QSEHRA really rounds it out, because you know what? The cost of healthcare has been increasing. I don't have to tell you that, preaching to the choir here today on that topic. So a QSEHRA might be an option, and I tell you, it's a very welcome option here today, certainly for small employers. So as you guys have been thinking about, you know, I think when the 21st Century Cures Act first came out, you started hearing about this qualified small employer HRA, you probably were going, what, Steve, do I care? I mean, I'm a benefits broker. I want to sell benefits. I implement group health plans with all sizes of employers, right? I mean, so that's where your specialty lies, your expertise lies. And now what I want you to think about here, as we just talked briefly about some sales strategies, is think of ways that your employers are trying to adapt to the rising cost of healthcare. You know, honestly, they want to provide benefits. They need to, right? I mean, they need to recruit quality employees. They need to retain the quality employees that they have. If they're not offering benefits, whew, how are you going to attract employees and retain the good ones that you have? So what I want you to begin to think about is utilizing QSEHRA in a way that could open doors, because opening doors leads to greater opportunities or future opportunities here in play. So let's just go through just a couple examples here, if I may. And I've just kind of broken this out in a couple different ways. The first is a sales strategy around, you know, if you're in the acquisition mode, right? You're in prospecting mode. You're looking for business. You're going after business, right? So here, a small employer that you are now prospecting with, they're removing the group health plan, right? In one respect, you didn't have an opportunity like this before. For the first time, if this is a qualified small employer, a non-ALE, you have, I mean, hopefully you will consult and advise them that they need to keep their group health plan. But due to whatever reasons, they choose to remove or not implement a group health plan. Here is your door opener. So for the first time, you can go in and at least establish a benefit for those employees under the Qualified Small Employer HRA. You also want to consider other additional revenue opportunities that could tie into that QSEHRA benefit by introducing worksite benefit offerings. You know, your cancer and your critical illness and just other things that you could put in place with that employer. Because you know what, most of the times a small employer, this decision to not offer a group health plan is not a never, it's just a not now. And so utilizing the Qualified Small Employer HRA as a door opener can be really huge. But now let's think about retention, right? You have retention efforts going on. You have a current client base that surely you want to keep that group health plan in place, right? That's why you're there. You want to do that. But now your small employers or employer is coming to you saying, hey, I'm removing. I'm no longer, I can't afford it. I got your renewal rates this last plan year and I can't do it anymore. So again, a door isn't closed, but a door is clearly propped open, actually wide open, because you're already in the door, and here's now your new option for those small employers with QSEHRA. And again, with the revenue opportunity, if they are going to remove the group health plan, you want to consider introducing a more robust worksite benefit type of a program with that employer where you can increase your revenue, you know, at least establish a solid or consistent revenue stream with that client. Let's look at a group health plan. You know, Steve, that's where employers are removing the group health plan, right? But what if they're going to retain? I mean, they're fighting it year after year with the renewals. They're fighting to keep that group health plan. So let's again first look at acquisition. You're in prospect mode. You're acquiring new business, hopefully with many employers. So, you know, one of the things that I want to mention as a door opener is that, you know, for one, the QSEHRA is not an option, right? So one, we need to determine whether they're a small employer under the definition of a non-ALE. They might be that, but if they're offering a group health plan, you know, we can't offer a QSEHRA. So I want you to go in with these things in mind. At PrimePay, we have kind of our purpose statement here is, and we believe that every group health plan should be paired with a pre-tax benefit account. That group health plan clearly has many out-of-pocket medical expenses that the employees of that company are financially burdened under. Utilizing a general HRA, a retiree HRA, other accepted benefits, they're permitted with a group health plan, right? So a health FSA can be offered. So you have an opportunity really to assist and drive additional support for those employees to really help and assist them through that financial burden of consuming their health care. And lastly, too, revenue opportunity, beautiful, right? They continue with the group health plan as you have proposed, you become the BOR, and then you connect that group health plan with additional ancillary voluntary benefit offerings. As we look at it just one step further on the retention side, you know, here again is on the retention, these are your clients. You sit with them yearly and maybe quarterly or monthly. You know, they're going to keep their group health plan. It is imperative that they do. So again, very much the same as in the retention, but maybe you have not come to that employer with more of those additional options. You know, have considerations been made for the general HRA that could be connected or integrated with that group health plan? Maybe establishing a retiree or an accepted benefit HRA would be extremely beneficial. But also on the revenue opportunity side, you have a real opportunity to connect that group health plan with a more robust ancillary voluntary benefit offering. Definitely, absolutely can be impactful to the client. And so again, with this particular example, since the group health plan is retained, QSEHRA is not an option. But don't let that pre-tax benefit account that discussion drop. There might be additional ways to assist and support those employees through the financial burden of consuming their health care. So next steps. I mean, I remember back in 2002 and 2003, HRAs really just became born under Section 105, you know, we kept telling brokers back then, you know, you need to be the first to communicate this information. If you don't, others will. So you need to talk about those options and what's before them. You can truly solidify the relationship if you not only secure a group health plan, but you can also solidify the relationship if you secure a qualified small employer HRA. I had mentioned that by doing that, that's not our first choice, right? As a benefits broker, we want the group health plan, but if we can't get that, let's keep that door open, and you can do that by recommending, communicating the benefits of that QSEHRA offering. You do want to stay focused. I've mentioned this in other webinars. This conversation with the owners of that company gives you a real, actually a real exceptional way to establish a greater or more robust ancillary benefit offering. And so you want to try to pair a pre-tax benefit account as applicable and where it mostly applies. The last thing that I want to talk about is, as you are securing and solidifying the relationship, you do need to always talk about compliance. I had talked about some key things in regard to the QSEHRA, right? Penalties that could exist for the not providing notices. There is some transition relief, but there's that penalty there. There's the W-2 reporting that will now be needed here as we go for the 2017 tax year, okay, that will be included. So there's different things that you need to ensure compliance with, right? Informing that employer about the affordability rules and just how affordability or how the HRA amount can impact the affordability or the qualification for that subsidy. So ensure compliance requirements. Talk about the notices and disclosures, the plan documentation that's needed. Don't forget about the other health and welfare plans that they may have that where Section 125 or Section 105 or ERISA is going to impact. Audits are happening, so ensure that you're talking to your clients about that. PCORI fees where appropriate. A PCORI fee is not applicable to a QSEHRA, okay, but it is applicable to general HRAs. ACA reporting is applicable where needed there with certain types of HRAs, not here with the QSEHRA. But something that is out there is that annual non-discrimination testing, and so ensure that every plan at QSEHRA is acting in a non-discriminatory basis. So I hope that's very helpful. We've wrapped up the content here on the QSEHRA here today, but I wanted to actually leave you with just a couple thoughts, if I may. I've had the opportunity to be kind of in the conversations here at PrimePay over the last many years, actually probably 10 years ago, in determining whether PrimePay would actually start to compete with brokers, would start to compete in selling health insurance to clients. And 10 years ago, we sat around the room and our CEO made a commitment at that time that PrimePay would do all that we can to actually not compete, make it clear that we would not compete with brokers in selling health insurance, and that we would do all that we can to wrap and equip our partners with the solutions that we provide. So many of you have known here over the last many years that PrimePay has stood on our commitment to not sell health insurance, and we entered 2017 with that same commitment. About 5 years ago, we introduced the Broker Concierge Partner Program, and it was our way to be able to actually drive a greater partnership for those that see PrimePay in a way that they want to become or be the broker of the future. And our mission as part of Broker Concierge is to build the broker of the future by enabling agencies and their brokers to adopt world-class business performance solutions as their own. As many of you know, we provide a lot of comprehensive suite of services here at PrimePay, all the way from pre-employment screening services, solutions, to time and attendance systems, payroll processing solutions, tax filing solutions, to pre-tax benefit accounts, ERISA, ACA, COBRA compliance. We run the gamut of administrative and compliance solutions. And our purpose through all of that is not to inundate you with all the different solutions that we have, but it's for you to think as an agency, how can I utilize PrimePay to actually be that broker of the future, always be on that cutting edge? So our purpose with Broker Concierge, if you will consider joining PrimePay's Broker Concierge Partner Program, our purpose is to do this, and our commitment is to do this. One, we want to strengthen client relationships. We want to utilize the solution, the tools, resources, the educational resources that we provide, and we want to enable you to have a stronger client relationship, because we know that if you have a happy client, then generally we all are happy. We also want you to be able to neutralize competitive threats. ACA has introduced new kind of competitive threats, new entities that are out there. And I stated here before, our Broker Concierge Partner Program is actually established to not compete with you, but to be able to take the various solutions that we provide, be able to wrap them around your agency, and you drive those value-added solutions to your clients. The third thing here that Broker Concierge wants to do as far as our purpose is to meet client demands. You stated in our yearly broker survey that the client demands are enormous and that they're asking for more and more and more. What Broker Concierge is created to specifically help you meet those various client demands, from compliance to administrative to whatever that may be. And so we want to, our purpose is really truly helping you meet those client demands. And then lastly, creating a new revenue stream. Let me use this as an example. So I just talked about the QSEHRA here today. Under our Broker Concierge Partner Program, we provide a commissionable revenue stream for you. If you refer PrimePay and our QSEHRA administrative service solution to your clients, as a Broker Concierge Partner, we can create a revenue stream for you. We want you to consider PrimePay as a book, and we want you to build a book of business here at PrimePay, which can absolutely be that supplemental piece of new revenue stream for your agency. So the final result, what we ultimately want to provide and bring to you through Broker Concierge is are these three things. Utilizing PrimePay as a partner, we want to give back. We want to be able to create efficiencies for you and your clients. We want to help you actually reduce those rising healthcare costs, but also business costs. So we want to be able to control those costs. And then lastly, which we do on a daily basis, but we're going to help you tremendously to mitigate compliance risk. Allow PrimePay to take on a lot of that liability here from you and your agency. And so Broker Concierge is really meant to take all of those solutions that we offer, but to really ensure that we differentiate those solutions with your agency. And so I strongly would encourage you to reach out to our Broker Concierge team, because ultimately what we want to do through Broker Concierge and our partner program is to allow us to help you crush your 2016 goals and objectives and maybe your revenue numbers here in 2017. We're excited about driving success in a partnership together. So with that, that will conclude our webinar. I want to just touch on just a couple of the follow-up items that we have for you. There will be a follow-up email that will come to you probably right around Friday of this week. Within that follow-up, there'll be a link to the recording. And for those who are not Broker Concierge partners with us, we'll provide additional details on how you can get more information about Broker Concierge and what that means for your agency. But we do have some exclusive, couple exclusive things for our BC partners. One, we will also be providing you with the presentation slide deck that I went through today. You can have it. It's yours. Use it. Use it internally. Use it with clients as needed. You're free to use that as you need to. But For our BC partners, we have just created, hot off the press, a brand new HRA ebook. And this ebook is comprised of everything HRA, from what I just discussed today with QSEHRA to what general HRAs mean, what retiree and standalone HRAs mean, all the way to HRA and COBRA continuation. I think you're going to find a lot of use out of this HRA ebook. And so we, more than ever, are looking forward to earning your trust, your client's business here in 2017. We thank you so much for the opportunity to have worked with many of you in 2016 and are just excited about what this year will bring. So with that, that will conclude the webinar here today, and we will get back to those whom I was unable to answer questions. We will get back to you here directly, but have a great day and a great start to your year. Thank you and have a good day.